I want to cover a bunch of different things today. I want to touch on the stock market, the economic cycles. I want to touch on unemployment, people's savings. I think we're moving into an AI capitulation in terms of the tech bubble really sparking things off. We'll touch on our positions. And then I also want to talk about real estate real quick because I think there's an eye-opening experience for a lot of people who just haven't heard me talk about real estate yet, and where I think we are in the overall cycle. So let's kick things off with if we take a look at the overall cycles here. The blue cycle is our stock market cycle. The yellow is our economic cycle. I touched on this, I think, last week as well, but it's important that we all know where we are in the big picture. I am bearish on the markets looking forward 6, 12 months or longer. But overall, industrial capital goods, precious metals like gold and energy stocks, they tend to do very well near the end of a bull market phase, and they have been doing that. And I want to kind of show you kind of what that looks like and where we are right now. So if we were to take a look at the SP 500 here, and let's just go way back to the 2008 financial collapse. Let's pull up this is a blend. This is gold, consumer industrial capital goods, and energy stocks. And if we just zoom in at the more current price action here, well, in general, if we take a look, they're trading it's in a strong bull flag, pretty much near all-time highs, just like the stock market is. But if we go back in time, now these ETFs don't go back enough for the tech bubble. I'd have to pull up other types of indexes for that. But what we want to look at here is if we take a look, we can see how they performed in the past. Now, the SP 500 in the top chart, stock market topped out many months earlier than the defensive sectors. Again, remember, we're looking at these industrials, precious metals, and energy. The stock market pulled back 8% from a high to when the defensive sectors and assets topped out. So you can see there's a huge divergence here. Stock market falls 8%. These late stage assets rallied 14%. So that's a 22% spread based on the different assets here. And then, of course, the stock market went off into a big sell-off. We saw a much larger sell-off from there. We saw the stock market sell off another 53% from there. And more or less from here, we saw these commodities fall about 40%. So the key here, and I harp on this all the time, the key is when we're in a bear market like this big phase right here, almost all assets go down, including these safe haven plays, as you can see. They just might not go down as much. Instead of 53%, it goes down 40%. So they do outperform, but you still lose your shirt. The key is understanding that there's divergence. When these do well and the stock market is struggling, we got to be aware that a stage 4 decline is coming and everything is going to get wiped out. And we need to manage those positions. So I believe, we're in this, I think I just hit some funky button here. Let me just auto scale. We're going to see how this goes. This stock market may start to stall out over the next couple of months and start to trade sideways or lower. And we could very easily see gold, energy, industrials continue to move higher or sideways while the stock market starts to go down. So that'll definitely be one of our warning signs in the market that we need to be aware of about a big reversal taking place in the overall market. Now, if we go and take a look at the next kind of wave here, what's really interesting is typically we see government jobs as a total of job openings start to really spike. The government, this is just my opinion, but I feel like they're always trying to manipulate the data and try and make things look good, better than they are. And so they open their doors and create all kinds of new job openings when things are getting rough and tough for the economy, to try to make it look like unemployment is holding up and all that stuff. So they open all these jobs. But then we go into a tech bubble. We had the financial crisis the last time we got into this. Started to climb into the COVID recession. And here we are climbing again. And this looks like it's probably indicating that we're coming back in to some type of financial reset in the markets. Now, what's interesting is, even though there are lots more job openings taking place from the government, and they're making more jobs available, unemployment is actually still rising. So they're not covering the spread, the difference there. And each time, this is a 24-month moving average. Each time we have one of these red bars, this is when the unemployment crosses above the 2-month average, and it sparks some type of a stage 4 decline, which is generally a multi-year, takes multiple years to recover from price-wise. So that's kind of where we are in a nutshell. I found this other chart here talking about full-time employment, year-over-year change. We are starting to already break down here with full-time job is starting to decline. I think there's more part-times kicking in. Businesses are slowing. I just read something about people are expecting the SP 500 sales they believe they've peaked. Businesses are starting to go on the decline now. Businesses are slowing. Quarterly sales are declining across the board. And of course, that means people are laying off full-time people, hiring more contractors or part-time. And that's why we're seeing full-time jobs go down. Companies got to trim, try and stay profitable. If we take a look at post-COVID, a lot of people had saved up a ton of money. We are now down into the zero, meaning people have burnt through their savings, which makes sense. People couldn't spend anything. They saved up lots of savings during COVID and the staycations of not going anywhere. But now they've burned through it. And of course, we have unemployment rising. So more and more people are losing their jobs. They're burning through their savings. And this is not a good sign. People are slowing down on sales. That means that's why we're seeing business sales slow down. People aren't buying as much. People are tightening up their wallets. Again, I think all this is going to lead to a stage 4 decline. I believe we're in a topping phase for the majority of the stock market. Maybe I'll show you a blended chart of kind of why I think we're here later. But overall, I think we're going to go into a big financial reset. Let's go and take a look at some other angles on the market. So we had Bank of America. They came out last week and said they believe AI has hit capitulation. That was this AI bubble. If we take a look here at NVIDIA, it's had a very, very strong pullback. Let me just bring this down a bit. Very strong pullback and knee-jerk reaction. There's quite a bit of volume on this downside, which I'll just pop the volume back in here. But overall, this is a very sharp pullback to a key moving average. It feels like it's an overreaction. We had a very similar type of pullback over here. When you have a really strong run and create a new trend, the first sharp pullback to a key moving average, which I consider the 20-day, the pink line, a key moving average, the market tends to bounce. It might not rally to new highs, but you should have a strong bounce off it. Well, we've had another consolidation, and now we've had a very strong run, and now we've got an overreaction. Again, we had a big volume spike over here. We're having a volume spike here, people panicking out. As the market goes, it tries to buck people out of a bull market, and this is what a buck looks like, a sharp pullback. People panic, hits headline news, and they bail out. You get a big surge of volume, and then it can continue to go up and push to new highs. Now, overall, this is a very strong chart pattern still. Last time we saw this, the market rebounded with a vengeance. This was around news, and then it pushed up to new all-time highs. So it'll be very interesting. It's interesting to see how this unfolds. We do have our short-term momentum charts here generating an oversold kind of buy condition in NVIDIA. It's saying, hey, it's hit the 20-day. It's actually oversold as well. And we could see this market, see NVIDIA bounce and rip higher once it spooks out all the really, really emotional, sensitive people who are watching literally every tick on the chart. And as it starts to move down, they all panic out. And that's what that volume is on this chart here. So that'll be interesting to see how that unfolds going forward as well. Now, if we take a look at our overall strategies, the key here is to understand that we are still in a rising trend. We had obviously a falling trend back in 2022, and we are back into this rising tide. So in general, we want to be long stocks. Sectors, individual stocks, not so much, but we want to be long the stock market. We want to ride the tide, not try and pick a boat that might move fastest in this kind of condition, this weather. And more or less the key here is to understand that when we're in a rising tide, we get beautiful, nice long trends. We can make a lot of money. In 2022, we made very little, but we protected our capital. Stock market fell like 22%. We ended up making about 5.5%. So it's a huge 25% spread difference. Big difference there. And of course, we're riding this market higher and our accounts, keep hitting new all-time highs as we push up. And of course, we get these longer trends. We get some nice longer trends where we lock in some big gains. We've recently locked in gains on our SPY, our QQQ, and we're just kind of sitting tight, waiting to see if this market is going to push and go higher. When we look at the short-term chart, you can see our trigger, we've popped up and we have a little bit of a pullback. A lot of people are thinking the sky is falling again, but really all we're doing is having a little bit of a pullback in the market. And typically when we look at let me just go to the NASDAQ. NASDAQ, same type of thing, pulling back a little bit more because it's tech heavy. We really are in a tech-driven market. Almost all session today, all these key sectors in this table right here were green, except for technology. Consumer discretionary just started to go negative here recently and pulled back. But overall, it just goes to show that the stock market has been going up. I just did a talk with David Lynn actually today, and he pulled up some interesting charts and talked about how every sector of the key sectors for the market are underperforming the SP 500. The only one outperforming is the technology space, and it's dragging the entire market up with it, even though the rest of the sectors are underperforming. So that's telling us we are in a bubble phase. One pocket of stocks is doing all the work, and most stocks are actually struggling quite a bit. And that is the AI bubble. And the AI bubble may not be over yet. As I just mentioned, NVIDIA is primed and ready for a knee-jerk reaction bounce. We did just have some FOMO early this morning on this indicator chart. That means we actually might see NVIDIA flush down a little bit more, maybe even have a big gap down tomorrow. And then we see buyers step in and drive it up for a big reversal. We'll just have to see how this plays out. But overall, NVIDIA is having a sharp pullback, and I believe it'll want to push back up to these highs or higher still. And we could see a big final blow-off phase. As investors and traders being close into this, definitely feels like it's getting frothy and toppy. But keep in mind right now, I think it was, who was it? It was Goldman Sachs, I think. No, it was Bank of America. They said that we had the money flowing into technology funds was the largest weekly inflow ever last week. So we are now into, like, to me, this is like where bubble phase kicks in. So some of the biggest trends and moves happen right at the end of a trend, meaning, let me zoom out on this and squish it down and clear it up. Even though we know the markets are overdone, I believe we're so super close to a reversal. Once you have the general public just flooding the market with their money, it's not like you have 10,000 new investors going in. We're going to have like millions of people piling in with a few $100s, couple $1,000, but there's so many of them, you can't stop that train. And so we're in this bubble phase where there's potential that NVIDIA, the tech sector, the stock market has some big blow-off euphoric AI phase. There is no stopping the train when the whole world piles in. I remember when it happened 2018 or whatever it was with Bitcoin. I remember the feeding frenzy on New Year's Eve. All these seniors were buying. It turned into like just a fun thing. Everybody had to go and buy Bitcoin on their Visa over the phone. It was so ridiculous. And then the market topped and it collapsed from 80,000 to 16,000 over time. So anyways, that's kind of where we're at. We're going to continue to ride this trend, but we just know we're now in nosebleed territory, and traders are going to lose, or the market makers are going to lose control. It'll be a bubble that they can't stop the stampede of money piling in, or when eventually the trend will reverse, and when the masses all start to panic, there could be a huge deflation event. And all these people are emotional. The reason they're paying and chasing prices up is because they have FOMO. Their emotions, they can't take missing out on it. Their friends have it, but they don't. But once they start to lose, fear is even stronger than FOMO in many cases, and they will panic out, and what goes straight up can come straight back down. And if we look at this chart, it is pretty darn parabolic, tulip spike style, although AI space is new and massive. But it is, you can see the obvious parabolic move, headline news, everybody trades it. It is a red flag that it's probably going to have an abrupt ending at some point. Let's touch on real estate real quick. Real estate, this is actually pretty interesting. I did an article and I've done a video on this in the past. And I talked about it right back over here as this was breaking down. I think we were here or here. And I talked about how the trend, this is just single family homes, but there was multi-family construction starts as well, which to me is actually even more important. But this one, the single family home starts, is more so of the general public and their thinking and what they're doing. So the market, to me, the real estate market has broken down. It's having a bounce to come up to this resistance area and give it a kiss goodbye. And eventually, I think we're going to see this sell off. Typically, when there is a very strong run in any asset class, NVIDIA is the same, I think, right now. When you have a big pullback, it can happen a couple times near the end. You get a sharp pullback and then people just say, oh, it's a screaming deal. I got to get back in. And they build more homes and they buy it back up. And we've had the same. It pulled back. Everybody thinks real estate is a killer buy long-term. And, they go and they start building more homes because they think they're going to make a fortune and they're driving this back up. But I think we're going to see homes start to decline and slow down again, the housing starts. Now, what's interesting here is I don't have the chart, but the multifamily construction starts spiked up huge last year. And that's what happens in real estate. The savvy investors move and they do multifamily, which is really the better investment long-term anyway. But the multifamily starts spike because there's no more money in single-family dwellings. They're just too expensive. Multifamily, you get economy of scale. You have one piece of property, you can stuff on 12 apartments, and they share walls, they share the same roofs and the same everything, a lot of stuff. So it becomes much cheaper. And because home prices are expensive in a bubble like they are, multifamily homes become affordable for those with not great jobs. They can only afford apartment or rent an apartment or condo, something like that. And so when we see a big spike, that's usually the last hurrah of smart or money moving into the real estate space for whatever is left to squeeze a bit more out before the market tanks. And right now, I mean, there's building around me like it's going out of style. It is nothing but subdivisions and multifamily buildings going up, and pricing is already starting to fall. People are backing out of their subdivisions. It is pretty crazy. Things are coming to a halt. But let's take a look at what that looks like from potentially a real estate ETF. Now, real estate ETFs are not the same as owning your house. Let's go back and take a look at this. I just want to make sure this is clear. So what I want to show you here, this is the IYR US Real Estate ETF. But all this stuff is going to be the same. In my opinion, it's the same. Doesn't matter what country you're in. When the US or the world, we all go into a recession generally together. There'll be the odd country or asset that bucks it. But this is the same for Canada and everywhere else. In fact, UK is already in a recession. But what happens is we have a huge move up in real estate. We get into this kind of a blow off top. It finally starts to crack and break down. And then real estate consolidated for a little while. Now, this is 2007 where real estate topped out. It pulled back quite a bit and then consolidated for a while. And then we went into the 2008 financial crisis and had that big leg down, and it was a huge correction. We saw real estate fall. This real estate ETF, 78%. On average from the pause here, it fell roughly 65%. So I'm not saying your homes are going to fall 65%, although I did see homes fall much more than that back in the 2000 crisis. This is what investors value companies who buy real estate. So investors will sell the shares of these companies and drive the shares under value. And these are actually screaming opportunities to pick up real estate ETFs. If you don't want to go and buy a building after a bear market, this is my opinion, when these stocks are beaten up and they're way undervalued, you can go in and buy these REIT ETFs that are way undersold, and they'll be paying big dividends. They have tons of upside potential. They'll always be paying a nice juicy dividend, especially when you pick it up near a bottom. So there's some good opportunity. But where we're at here is we had, I believe, the top we've had the move down, and now we're in this consolidation phase. Again, this is like stage 3 topping phase, stage 3 topping phase. If I pull that up, you can see here, you have the blow off move, it breaks down, it consolidates, and then it goes into a stage 4. So obviously real estate looks like in due time, it's going to go off a cliff, and real estate ETFs are going to get hit really hard. And of course, it'll create an amazing opportunity. Nice thing about these is anyone with $100 or $30 can buy into real estate and become a real estate investor through an ETF. But you definitely don't want to buy now. Definitely need to wait for a market reset. And unfortunately, a lot of people think this is a market reset. Maybe it is. Maybe I'm super wrong. But the charts and everything else are telling us that there is another leg down. And it's that next leg down that literally pulls the rug out from everybody's feet and hits them blindsided. And people suffer. But when people suffer, it creates opportunities for those who spend the time and money and to learn about this stuff like you guys are and what we do here. So that's kind of a really interesting take on the market. Other than that, that's kind of about it. I mean, we do have utilities moving up really nice today. Utilities, consumer staples, and healthcare. These are 3 defensive sectors. No matter what happens in the world, we need running water, electricity, consumer staples. We need basic materials, foods, supplies. And then, of course, we all need our health. So no matter what, when people get a little nervous, we tend to see these do well. Most sectors are doing well today, but these ones are doing very well. But they do give us a warning sign. If they perform very well, it can mean that we're getting closer to a stock market decline. In fact, utility stocks topped out, had a huge move, a huge outperformance just before the COVID crash. XLU dramatically outperformed the SP 500. And I'm not sure where we are in terms of the SP 500 right now. Let's take a quick look at this. Let's take a quick peek and see if we can just go percentage and percentage and 2024. So utilities aren't really outperforming just yet. It'll be interesting to see if they do start to extend and move higher, a lot like I showed you with gold, energy stocks, and industrial capital goods. But overall, we'll keep our eyes peeled for that because the last time we saw this is a strong bull flag. If this pushes up for another leg higher and the stock market struggles, that could definitely be another early warning sign that the stock market is very close to going off a cliff and putting in a top. Anyways, that's about it. Overall, we're long the markets. The trend is still up, and the market climbs a wall of worry. I know a lot of you guys are worried that this market's ready to pull back. And of course, the market's always ready to pull back. That's how it always makes us feel. We just have to stick with it, let it do its thing. When we take a look at this price action here, it looks no different than this price action here. It can keep going week after week after week. This is the weekly chart, and the fact that it really has popped, paused, popped. It's having a pause. This is another little bull flag. A couple weeks sideways next week, for all we know, or by the end of this week, this thing pops up and we have another big bar. So don't get caught up in the short-term charts. And anyways, that's about it. This video is way longer than I thought. Hopefully I didn't bore everybody. But a lot of cool stuff I think we covered to get the big picture view of where we're at. Take care. Bye-bye.